Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Hey, this is Clay. We're just about to get into this conversation, but before we do that, I wanted to provide two announcements regarding Nomics.com, company that produces and funds this podcast. The first announcement is that we just hired Maya, the new editor for the blog. If you haven't been to blog.nomics.com for a while, go ahead and check it out. We've begun a project there where we're posting case studies of folks using the Nomics API. The first case study is with Bletchley Indexes, who recently switched from CryptoCompare to the Nomics API for their market data and for pricing their indices. Anyway, if you're doing exciting things with our API that you think the world should know about, then we'd love to hear from you. Reach out to us via contactnomics.com to let us know what you're working on and why it would make a great case study for our blog. Announcement number 2 is that we just launched our exchanges index page at nomics.com. You can check it out by going to nomics.com/exchanges. That page shows the number of trades executed across a number of exchanges, global exchange volume, which is a chart that, to my knowledge, nobody else has, and much more. Check it out at nomics.com/exchanges when you have a chance. Now to our regularly scheduled program. Today's conversation is with Kevin Zhou, head trader at Galois Capital, which is a high-volume US-based OTC desk. He was most recently head of trading at Kraken. Previous to that, he was head of trading at Buttercoin, which was one of the very first cryptoasset companies backed by Combinator. Kevin has been trading crypto assets since 2011. He also has various fancy academic degrees. This conversation is a behind-the-scenes look at OTC desks, how they operate, and how they make money. The term OTC desk is often thrown around, but there's very little talk about what happens behind the scenes at regulated high-volume desks. In fact, the world of OTC trading is pretty opaque. I know this because for some time now at Nomics, I've been trying to get OTC desk data on our platform, and it's been difficult. Given the reach of this podcast, I'm guessing that I could have done this interview with just about any of the top desks, but I decided to do this with Kevin because he was frankly the one willing to share the most information and because he's brilliant when it comes to breaking down esoteric financial processes. This podcast is broken into 7 chapters. In chapter 1, we discuss what OTC desks fundamentally are, the problems they solve, why they exist. In chapter 2, we walk through an OTC desk trade from both the point of view of an OTC desk client and the OTC desk. This is one of the most fascinating parts of this entire interview, and Kevin is surprisingly transparent during the segment. In chapter 3, we put on our historian hats and discuss the history of OTC desks and OTC trading and the origins of this business model. In chapter 4, we discuss the components and attributes of OTC desks. In this chapter, we peel back the curtain on the core components of OTC trading. In chapter 5, we discuss the kind of OTC desks that can exist, the different types of institutions that create them, and their various motivations. In chapter 6, we discuss control and regulation, both in the US and globally. And in chapter 7, our final chapter, we discuss what the future holds for OTC desk, crypto trading, and the business model. I should stop for a moment to tell you that this episode is made possible by the support of the Nomics API, which my company makes. Here's a little bit about that. Do you need an enterprise-grade crypto market data API for your fund, smart contract, or app? Nomics is an API-first cryptoasset market data company. Our product is a developer tool for funds, family offices, enterprise, and fintech developers. Our API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. If you found that you or your developer have to spend too much time cleaning up and maintaining datasets instead of identifying opportunities, or if you're tired of interpolated data and want raw primary source trades delivered simply and consistently with top-notch support and SLAs, then check us out. One notable difference between the Nomics API and competition is that the Nomics product has no rate limits. If you're an enterprise or fund that requires error rate, uptime, and accuracy guarantees along with email and phone support, then consider using the Nomics Crypto Market Data API. Go to nomicsapi.com to learn more. Okay, let's get this started. Here, without further ado, is part one of our conversation with Kevin Zhou, former head of trading at Kraken and current head of trading and founder at Galois Capital. Kevin, thanks for joining us today. Can you tell us a little bit about the origin story of Galois Capital and what compelled you to start the company?
With Galois Capital, it was sort of an idea that was brewing, between me and my co-founder. His name is Mael. We went to school together back in the day, studying financial engineering, getting our masters at Berkeley. And, we always kind of wanted to start a company together. And, we never found the right timing. After school, I went directly into crypto and he went into data science at another small startup. So, I worked in crypto first at Buttercoin for 2 years. It's a very small exchange. I think it was the second company to be backed by YC. That was a crypto company, the first being Coinbase. And, worked there for about 2 years, running their OTC desk. And then, afterwards, things weren't going so well. This is sort of like, after 2013, there was a huge bear cycle. And, it was just a very brutal winter, I think, for all of us. And many companies went belly up, including Buttercoin. That didn't pan out very well. Through that experience, it helped me get a job at Kraken. And I ran the trading desk for Kraken for another 2 years. And then finally, and this is around end of Q1 2017, so last year, we felt like the timing was right. And, I felt like, I'd been trading in crypto, for these two exchanges, running their desks for 2 years each. And then even before that, for myself personally, for another 2 years. So, at that point, I thought, well, it's about time to go strike it off on my own. Reached out to Mael. And, for him, it was, getting to that point too. He'd built out a lot of experience building out the architecture and sort of back-end systems and machine learning algorithms for his data science company, his data science startup. And, we thought it was about time to go set up shop. So that's sort of the genesis of Galois Capital. Me and him, we both, studied math in undergrad. So I guess in some ways to pay homage to some of the great thinkers of the past, we wanted to name the company after a mathematician. And, there were a couple names that were kind of being thrown around, like, Mandelbrot or Julia, Galois. In the end, we settled with Galois. We started the company. And I also think, from another perspective, the name of a company is the first thing that anybody ever knows about a company. So, we wanted to sort of attract the right talent. And, we're both quants by background. And we definitely think that crypto is moving more towards algo trading. The game only gets harder, more electronic and faster. So we really wanted to set up for the future there. And we wanted to attract, people who had an appreciation for very high standards of rigor, as you find in math, especially when you're doing like proofs. So, that's part of it is, just functioning as a light recruiting tool. We have been approached by some folks who really like the name. So, I guess it's worked to some degree. And, that's ultimately genesis of the company.
With that background established, let's jump to chapter one of our exploration of crypto OTC desks. Can you tell us a little bit about what an OTC desk is in sort of maybe the most primitive terms possible and what problems they solve, regardless of whether or not they're crypto OTC desks or other kinds of OTC desks?
OTC stands for over the counter. What it basically is that, sometimes, some kind of investor or trader, they need to move a really large size, a really big block trade in a particular asset or in their position. So, normally when you would, do that on the screens or, in the lit venues or, basically in the order books, you're going to subject yourself to a lot of slippage. To explain that a little bit, slippage is this idea that if you buy $1 of Bitcoin, you're probably just going to hit the best offer, right? The lowest offer. If you buy, $100 million worth of Bitcoin, the best offer is not enough. You have to go down the order book. You have to start lifting more and more offers at less and less favorable prices. So ultimately, when you get that order executed, your blended average price on that execution is much worse than, if you were to just trade $1, right? If you were just buying $1 worth of Bitcoin. So the idea of slippage is that the larger the size that you're doing, the worse the average blended price you're going to get is on that block. Since, people trading these large blocks face this problem, OTC desks are there to service this issue and hopefully reduce costs, right? To reduce slippage for this trader or investor. The idea is that when you trade with an OTC desk, the desk functions in some ways like a dealer. What I mean by that is a customer would come up to us and they would say, hey, I want to buy 1,000 Bitcoin. What's the price, right? Or they would say, let me see quotes for 1,000 Bitcoin. Let me see two-way quotes. So that means they want to see both bid and an offer for 1,000 Bitcoin. So then we would offer them some price, right? Let's say the price is at $100 and we say 99 bid, 101 offer. Effectively, they're able to get their entire block done at that price. And as long as that price is better than the blended average price they would get slipping through the order books, then the OTC desk would have saved them money. There's a question here, why would the OTC desk do this, right? The OTC desk, they're selling to them at 101, buying from them at 99, but then, they have all this inventory now, right? They're either too long or too short in their own inventory. Part of the job of the OTC desk for their own balance sheet is to figure out how to get rid of that inventory, whether it's long or short. And to the extent that, the counterparty to the desk has, the desk itself, let's put it this way. Let's say that the desk itself has better execution than the counterparty it trades with, then there's some sort of net value which is shared between both, right? The counterparty gets better slippage, gets a more favorable price, and the OTC desk takes some margin. So it's sort of a win-win situation, and it's effectively execution arbitrage, right? One group executes better than another, and there's some savings in between, and then some is split with the first person, some is split with the second person. So that's sort of, the idea behind OTC desks. OTC desks specialize in managing inventory and getting execution done. We can get into either side of those. I think the first is, if you think about it, there's a lot of different ways of managing inventory. You don't actually have to go to the markets themselves, right? The direct markets, right? The lit venues or the exchanges.
Hey, this is Clay cutting in here from the editor's booth to explain what lit venues are. Lit venues are the opposite of dark pools or dark liquidity, whereas dark trading venues do not display prices at which participants are willing to trade. Lit pools do show these various bids and offers in different assets. Exchanges operate in such a way that available liquidity is displayed at all times and form the bulk of the lit pools available to traders.
First, what you could do is you could use multiple exchanges, right? You have access to all the different exchanges in the world. You have some smart routing on your systems, and anytime you need to hedge off risk, then you sort of pro rata distribute the order out multiple exchanges. And then maybe you have some kind of scheduling, right? So maybe you just don't get rid of it all at once. Rather, you slowly massage it into the market. You slowly you want to minimize market impact as much as possible. Do carry some risk, some inventory risk during that time, but maybe your market impact, your slippage is going to be better because you do a little bit slowly and less aggressively into the market over time. So those are just some things that you can do just on the exchanges and lit venues to, hedge off your exposure. But there's a couple other ways to manage inventory. One way is that, there's a whole bunch of other OTC desks, and sometimes you can share risk with them. So let's say, counterparty buys 1,000 Bitcoin from you, right? Maybe you can say, well, I'm going to buy 500 Bitcoin from another OTC desk, right? The counterparty pays you, you pay the other OTC desk, you have a little bit less risk on your books, and overall, if there was another OTC desk, you could also, ship the other 500 to them, or you could just work the other 500 yourself on the markets. So, definitely sharing flow with other OTC desks is a way to get rid of inventory. And then the last way to do it is to warehouse the risk and wait for matching counterflow. So counterflow is the most valuable, I think, to an OTC desk. And what that is like, let's say Alice comes in and buys 100 Bitcoin right now from us. And then Bob comes in half an hour later and he sells us 100 Bitcoin. Well, then we've just naturally balanced ourselves out, right? We carried some inventory risks for half an hour, but in doing so, we avoided the need to have any hedging costs whatsoever. We make some profit on the spread with Alice, and we make some profit on the spread with Bob, rather than making profit trading with Alice and then losing that, or at least part of that in the hedging process and getting rid of exposure. So those are the three main ways I would say of managing inventory. And there's a lot of sort of nuance that goes into each one.
I think that's like super fascinating. Let's talk a little bit about some more of the basics here. So what are some of the things that differentiate OTC desks from other exchanges? So you explained how it solves the slippage problem where on most exchanges, the more you buy, the more the price goes up, and the more you sell, the more the price goes down. So it solves that problem. It's also the case that with OTC desks, that the desk itself is the counterparty to every trade. Is that more or less true?
Yeah, that's exactly right. At least that's the case for most desks. So I should say that there are a few exceptions, and it really comes down to that there's two models for OTC desks. There's the agency model, and then there's the dealership model. What I've been describing is the dealership model, and that is, the OTC desk takes principal risk and extends their own balance sheet to facilitate liquidity for the counterparty. The agency model is more, this thing where, Clay, you come to me and you say, I want to sell 100 Bitcoin. Here's my 100 Bitcoin. Get rid of it at as best as you can, and I'll pay you a commission for it. There's a lot of thought around which is sort of better, right? In some ways, the way I think about it is, purely from a game theoretic standpoint. If you, on an agency basis work with me and you're going to pay me a commission no matter how well I do, then I don't have much of an incentive to execute very well for you, right? If I execute badly for you and there's massive slippage, then, I still get paid. And if, I execute very well for you, I still get paid the same amount. So there's no real incentive there. This is very different, I think, from the dealership model, because in that model, me and you, we agree to a price, and then it's my problem. And I have a huge incentive to make sure that I'm doing execution well for myself because it's become my problem, right? And at least for you, you have some guarantee on the price, right? You know that, the market's trading at 100, but you're paying 101. So you know exactly what you're paying. You're paying more than what the market is currently at the spot price. It's less than the slippage you would have incurred just going through GDAX. And then there's no conflicts of interest between me as the desk and you as the counterparty. So I strongly prefer the dealership model, but I think there are a few that run on an agency basis too.
So that's helpful, that distinction. Are there also generally fees involved, or is it the case that, because of your expertise in trade execution, the agreed upon price is the agreed upon price, and you're pricing in whatever, profit you need to make or upside you need to make off the trade into the quote?
Yeah, that's exactly right. So for the dealership model, there are no fees. It's just everything is sort of baked into the spread itself. And the spread is the combination of two things. One is our own hedging costs, and two is our profit. So, certain desks, they want to take a little bit more on one side or the other. It really depends. I would say overall, things are very competitive and profit margins have gotten squeezed quite a bit. I would say in the last 6 months, margins have gone down by, a factor of 2. The space is definitely getting very competitive, but I think that's good for the counterparties and it's good for the consumer.
Do you know what the origin of the term over the counter is? I kind of scratch my head sometimes because it's just sort of an odd way to describe the business model.
It definitely came from the traditional markets. I'm guessing there was some counter and the parties would just negotiate over some kind of counter physically, maybe in the pits or something like that, right?
Let's transition here to chapter 2 to walk through what an OTC desk trade would look like, maybe starting from the point of view of someone who's calling you up to, maybe they want to sell or they want to buy some Bitcoin. Let's take this in sort of as many micro steps as possible. Maybe I heard about you from someone recommended you. I reach out to you via email and say, hey, I'm interested in making this kind of trade. How do these trades typically get initiated? And for someone who's never done business with you before, what would the next steps be?
I think the first thing is, we like to hop on a call with them and just make sure that everybody's setting expectations, understanding what both sides' obligations are and sort of what to expect. So in that initial call, we'll gather some information such as if they're okay trading in US dollar, if they want fiat, or if they want some kind of other currency, right? And we can't do RMB, we can't do yen, we can only do US dollar. So we want to make sure that we're able to trade with them in the first place. And then the second thing, obviously, is on the crypto side, we do trade a lot of different assets, but, we don't trade all of them, right? And we certainly don't trade unlisted assets and illiquid assets. At least, the ones with no mainnet, there's no way we can trade them. So we don't trade in, SAFs or any of those, sort of pre-launch ICOs. After we get through all of that, and let's say that we can do trades together, then we'll put them through our onboarding process. And there's really two steps to that. The first is to collect some KYC information from them. So we're a US company, and, we have to abide by KYC and AML rules. So, we'll collect very common things. If it's an entity, we'll collect things like, articles of incorporation, operating agreements, passports and or driver's licenses from the directors of the company and authorized traders. So very, standard stuff. If it's an individual, just personally identifying information. Once we have all of that, we run some checks on it and everything looks good. There's an OTC agreement to sign. And the reason that there needs to be this kind of agreement is because one of the main differences for how OTC desks work is that, everything is post-trade settled. And what I mean by that is that we agree on a trade and we book it, and that's final, and then we enter into settlement. So it's different from the exchanges where you would need to deposit your dollars first before you're able to make trades with it to buy Bitcoin. Because of that, there's some extra risk for us, right? As a desk, we don't know if the other side, really who the other side is. I mean, we know to some degree based on the information. We don't know, if they're credit worthy, if they're going to honor their trades, if they're ever going to renege. What if their business is just really terrible? They enter into default, right? And it wasn't even their intention to renege, but it's just a terrible business. So, they enter into default. Because of those considerations, there's a lot of counterparty risk involved. And we want to make sure that legally both sides are obligated to their leg of the trade. And that's what that OTC agreement is. It's to ensure that once a trade is consummated and what it means for a trade to be consummated, then both sides are legally bound to those terms. Once we're sorted with all of that, we can turn around paperwork pretty quickly. I would say that we've kind of streamlined that process pretty well, and usually takes us less than 24 hours from receiving all the information from the counterparty to being able to turn it over and get our first trade done. One of the things that we also ask the counterparty to provide is preferred communications channel. So we're very flexible. We're comfortable doing Signal, Telegram, WhatsApp, WeChat, Skype, even Google Hangouts. I don't recommend it. I don't really even recommend Skype, but we're very comfortable, however they like, we're open to doing it. And then for whatever channel they prefer, we'll open a channel. I'll bring in all my traders. They'll bring in their people that are authorized to trade, and then they can request a quote from us at any time. And that can be, two-way quote, or it can be a, one-way quote. And I'll say, as a reason for why people ask for two-way quotes, there's really two reasons. The first is not to reveal any information about what direction they actually want to go. So I think that there's some value there. And the second is just to see how tight sort of the market maker or the OTC desk really is, right? With a single quote, that, it's some ways away from spot, but you don't have any reference to how wide the actual spread is. Maybe the OTC desk is leaning, right? Maybe they're leaning down on their quotes. Maybe they're leaning up on their quotes based on their own inventory. So you don't really have a sense for how competitive they are with maybe other OTC desks. So seeing a two-sided quote would be good for that. They'll either ask us for a one-sided quote or a two-sided quote. We'll give them a quote. We'll see what we can do for them there.
And just for clarification, the leaning down or leaning up, that's, let's say you purchased a bunch of, Bitcoin and you're holding on to some inventory that you acquired relatively cheaply, and, you'd still have a whole lot of upside if you sold it for a little bit, below current spot price, right? That would be leaning down.
Mm-hmm.
Okay.
Yeah. I mean, one way you can lean down is you can lean it not so, heavily that it's crossing the spot price. And the other is that you're leaning so heavily that you are crossing. So, just to give you an example, let's say like when I'm neutral, I'm 99.101, right? 99 bid, 101 offer, right? Leaning down could be like 98.5 100.5, right? That could still be considered leaning down. But if I have very severe inventory imbalances, then yeah, I could go like 96, 99, right? I could do that, right? So I think it all depends on how each desk manages their inventory and just how badly misaligned their inventory is from their intended position of their inventory. A lot of that is art and some of it is science.
Contract submitted and a quote is requested. How long is the expiration date on the quote? Usually is it like 24 hours or is it custom for each quote? Or is there sort of a standard expiration date for these quotes?
Yeah, usually the quote is good for about 30 seconds, but it depends on it depends on the party. What's funny is you laugh, but I actually think 30 seconds is very generous. I think it's actually very, very long, to be honest. There are places that offer 10-second quotes.
Wow.
So it really depends. If we think that the counterparty is more on the toxic side, we would probably cut it off at about 5 to 10 seconds. Or if the market's moving very rapidly, we can always pull our quotes, right? So we can say, hey, we're off, right? So the slang is that we're off. That means we're off the quotes. Ask us, ping us for a requote whenever you want. It's the sort of thing where if you think about it, when I give you a quote, I'm effectively outlaying a very short-term free option to you, right? I'm effectively underwriting a call or a put, but a really short one, right? Like a 5-second call or put for you, right? And the optionality has some value, right? Like maybe most of the time there's nothing to be done, right? But every once in a while, some freak accident happens. Like I quote you at 1 p.m. exact, right? And then at 1 p.m. and 5 seconds, right? The market just completely rips or completely crashes, right? And then like if it's in your favor, then you take the quote. If it's like against your favor, then you pass on the quote. Then I've effectively just lost money to you for just outlaying a free option for no reason, right? So I think you never want to outlay a free option for too long, but obviously, you have to take into consideration that, just from a human element that people need time to react and to actually think about the quote and whatnot. So I think, 30 seconds is pretty fair. They have two options after that, right? The first is that they can pass and, no harm done. Both sides move on with business and they can come back anytime. And people pass for several reasons. Usually they pass because there's either a quote that's better from another OTC desk, or there is no better quote, but they think the quote is still too wide and they just don't want to take it. That's perfectly fine. I think we like to price things in a way such that if people walk away, then we're okay with it too, because even though we probably didn't make money there, we still didn't take on much risk either, right? So there's always some trade-off there. And if we're fairly indifferent as to whether or not our customers or counterparties are taking our orders, then it means we're pricing things pretty fairly, right? So that's one option. The other option is that they think the quote is good and they accept it, and then they say done, right? And once they say the word done, that trade is just done. We will send out a trade confirmation with the trade details, information on settlement, all of that stuff. But the trade confirmation is not when the trade is consummated. When they say done, the trade is done and there's no going back on it. If the market moves in our favor, if it moves in their favor, it doesn't matter. It doesn't matter who ends up winning or losing after the fact. The trade is done when it's done.
I have a whole bunch of questions around this. Can you take us to the moment of quotation? So you mentioned Signal. So let's say this is being done over like in a chat environment. Is it usually that you guys, like an appointment will be set to sort of work this out in real time? Obviously, if a quote is expiring in 30 seconds or even in with a potentially toxic counterparty, less time than that, I imagine it's someone on your side with a whole bunch of information in front of them, someone on the other side with a whole bunch of information in front of them. Do you have a countdown timer? Are you using the expiring messages function in Signal that sort of deletes like, how are you actually tracking this in real time? And then when it comes to the word done, is there something in your contract that literally says that if someone says done, that is, they cannot renege on that it is effectively, a point of no return? Is that just part of the culture of OTC desks and trading and that's just implicitly acknowledged?
Yeah, so let me address that first. I'm actually not sure exactly if that's written in the contract, but it might be actually. I do know that at the very least in the contract, it says that when a trade is agreed upon in a communications channel, then it is completely binding. I think it is the culture though in OTC that you either say confirmed or you say done. And, we're actually, in some ways it's kind of conversational. So sometimes not everybody knows the protocol. Sometimes people just, ghost for a while. They had to use the bathroom and then they missed the quote and ask you for a requote. So all of that stuff happens. I would say that, we're fairly strict about it because we want there to be some kind of record of somebody saying that something is done. So when someone says, we give them a quote and then they say, okay, I don't know what okay means. Does okay mean that you've received my quote and you understand that that's the price I'm offering you? Or does okay mean let's do it, right? Like okay is very ambiguous, right? That's why I think the word done is chosen, right? Because it done is done. It's unambiguous, right? The trade is either done or not done, right?
So in that case, would you write back to them and say, hey, not sure what that means. Can you say done? Or do you ask them to say done?
We do actually. I know it's kind of silly, but we actually do. So when they say okay, we go, so done ? And then they say, okay, done, right? Yeah, I mean, we don't do yes, we don't do okay, we don't do fine, we do done, right? Done and confirmed are the two acceptable responses to consummate a trade. Everything else is too...
It's like the opposite of a safe word.
Yeah, it's the opposite of a safe word. It's the danger word, but to get it done, it needs to be one of those words, so it's for good reason. It's because, most of the time there's not going to be a problem. 99% of the time everybody's on the same page, but every once in a while, there's just going to be a huge disconnect. One person's going to think one thing, one person's going to think another. And then you end up getting into disputes. And then there's, one person has a profit, one person has a loss, and should it then be shared or, how is it resolved? And then, it just gets messy. So just to avoid that altogether and sort of preempt all of the confusion that has happened in the past when things were ambiguous, I think the culture that's developed around being very strict about what is done and what is not done, it's a good thing. And what's also interesting is that a lot of times there's also confirmation for things not being done, right? So when I say, okay, I'm 101 offered, right? And then you say pass, right? Then I say, okay, nothing done, right? And it's just to say that both sides have, acknowledged that they're on the same page, right? You pass, so you're on that page. I'm on that page too. I've received your pass and I've confirmed with you that nothing was done, right? It's a courtesy to make sure that neither side is confused, I would say.
I actually think this is a really interesting aspect of OTC desk culture. And so I'm going to go a little bit deeper down this rabbit hole. So done is pretty much the only word you'll accept. If they don't use that word, you'll ask them to use it. What about the equivalent of the word done in other languages? Or do you only interact about these trades in English just to ensure that there's no ambiguity?
Yeah, we only interface in English, unfortunately. I know that there is a very vibrant Chinese OTC market, but as of right now, we don't trade any RMB. Unfortunately, I think there's only one person in our company that can even, have a basic grasp of speaking Chinese, let alone reading Chinese. So it'll be difficult. It's ironic because many of us are ethnically Chinese, but most of us don't speak Chinese or Mandarin or Cantonese at all. So it's a bit unfortunate. I'm a little bit embarrassed, but yeah, we only deal in English.
Let's talk about the sort of the setup or what it actually looks like on your side and on the counterparty side when these things are being agreed to. Do you set up an appointment to sort of agree to a trade? Who all is present from your side? Who is usually present on their side in most scenarios? How does this actually look?
There's never any appointments. I mean, I guess you could make them on an ad hoc basis, but for the most part, we operate the desk 20 hours a day, so we don't operate 2 a.m. to 6 a.m. Pacific time, and we operate it 7 days a week. So you can just ping the desk like anytime, basically, and then they'll give you a quote. We're always ready to provide quotes. It's not something that needs to be scheduled.
Obviously, that means then that you can't be present for every single one of these trades. How do you go about communicating what is acceptable and what is not acceptable throughout the org? Or are individuals like sort of responsible for and maybe liable for their own performance? And that's how, compensation is set up. How does this work? How do you delegate this?
I think you really have to hire the right people. I think that's sort of a cop-out, but it's really true, I think, probably for every company. I fully trust my trading team to provide quotes, to trade well, to do the hedging, to basically handle all of the trading day-to-day operations. It wasn't always the case. I think when, for the first 2 months, well, really 2.5 months, I basically did all of the trades myself. And, my co-founder is working on the tech and I was doing all the trades. We brought on these guys end of February this year and then early March. And then there's a whole training process, right? So we go through mock trading. I explain to them my thoughts on the market, my own intuitions. Even if I'm wrong, it's sort of the basis that I've learned how to do this. And then sort of the processes involved, right? And it's extremely operationally heavy. I would say that running an OTC desk is 75% operations and accounting and reconciliation and 25% trading. So there's a lot to get through. But I think after a while, and when you can see that, people are sort of wrapping their heads around it and the quality of their work is starting to get more and more error-free and pristine, then you sort of entrust them with greater responsibility. And then slowly, I've sort of let go of control of the OTC desk. And then one piece at a time, there's actually many pieces to it. And then now at this point, they completely run it autonomously. And I fully trust them. And they've actually done very well. And their compensation is very heavily tied to the performance of the company. We're a very unique company in the sense that, we have 8 people and 7 of us don't take any salary. We're extremely aligned in the sense that if we're all in a ship together, if it sinks, then it's really terrible for all of us. We all drown together. So everybody's just very motivated. And I never have to wonder about people's intentions. I mean, there's just no politicking whatsoever because we know that we're all in it together. So, and it makes it so that even to some extent, operationally and from a management perspective, it makes it a lot easier because I don't have to make sure that people are on task or whatnot. The trading is you eat what you kill, and I think nobody likes to starve, so I don't have to worry about motivation there. So, I don't think that's common. That is how we structured our incentives. So I guess long story short, yeah, they run the entire operations and I fully trust them.
No base salary, 100% bonus, eating what you kill, performance payouts.
Yeah, exactly. That actually goes for some of the developers too, and I think that's not very common at all. I mean, even in trading operations, even in prop shops, developers are usually paid a higher base and they have more of a steady and safer job. Don't have as much upside, but don't have as much downside. But I think for the founding team, I don't mind sharing the success of the company with them. And I think ultimately it aligns incentives better.
I want to make sure I have the timing down right. So you have someone at the trading desk on the other side. Is it usually just one person? Can one person independently agree to a trade on behalf of Galois Capital, or do you usually kind of require 2 people to be there and kind of both consent before you can agree to something?
Generally, the trading team they're always in the same room with each other, until they go home, right? But when they confer with each other. They just keep everyone on the same page. But they do have the authority to make trades on behalf of the company. Each of the full traders have authority to book trades on behalf of the company.
Is there something written into a contract that ties chat handles or identities to the contract holder? In other words, if someone just pops up in Signal and says, "Hey, I represent this company, we want to do this trade," do you just take them at their word, or do you reference some sort of contract and make sure that handle is authorized to act on behalf of the organization?
Yeah, there are some legal protections in the contract, but we don't do verification in that kind of way. So I'll explain sort of what the fail-safes actually are, right? So once a trade is actually made, we always double confirm settlement instructions through 2 different communications channels. One being our email and one being the communications channel that we agreed to the quote in, or we gave the quote and they agreed in. This is to avoid situations where, for example, there is somebody who has like Galois in their name on their Telegram handle pretending to be one of us, right? Then you'll never get the confirmation. They'll try and do a trade with you, but you'll never get a confirmation. So that wasn't us. And then the second reason is because there's a lot of, viruses and Trojans out there that, counterparties' computers can get infected by this malware where it'll replace your clipboard Bitcoin address with one of their Bitcoin addresses, right? So you're copy and pasting stuff, or they'll just change it on your screen. You'll open something up and it'll say their address actually. Because of stuff like that, we always go through 2 different communications channels. And that's just to double confirm the settlement instructions. Like once the Bitcoins are out, they're gone, right? There's no takebacks. Mistakes are permanent. So we're always very careful about how we do those confirmations. And then also, benefits from the exploit that you're talking about, which is like, there's some rogue trader, that sort of thing. Another thing to mention is that people's phones do get ported in this space, right? There's all sorts of phone porting attacks like T-Mobile or whatnot, Verizon or whatnot. If by porting the phone number, and there's certain things that are attached to the phone number, certain things that aren't, right? Like I think WhatsApp is tied to the phone. Was it Telegram? Maybe Telegram was tied to the number. Well, I don't know, but some were handled a little bit differently than others. There are provisions in the contract that say that it is the counterparty's responsibility to secure communications channels on their side, right? So if somebody ports their phone and they make a trade with us, technically they're liable for that trade, right? These are sort of the edge cases that, and I'm glad you brought this up because it's very important. These are sort of the edge cases where a lot of sort of like the operations, the processes, the design of the contract, all that come in, right? In drafting that thing up and in setting expectations with the counterparty, there's a lot of sort of even uncomfortable conversations that need to be had about all the crazy edge cases and corner cases that can happen, and then who's responsible for what. So I would say that before you ever sign a contract with an OTC desk, read very carefully what is expected of you and what is expected of them, and then who shoulders the blame and the loss in the event of event A, in the event of event B, and so on and so forth. I think if OTC desk is fair, you'll see that basically in common English, if it's your fault, it's your fault. If it's my fault, it's my fault. And it's pretty fair.
So there's two channels that are required for confirmation of settlement transactions. But what about sort of just agreeing to a price for a trade? Is that also required on two channels within 30 seconds? Are you okay with that from just one channel?
Yeah, just single channel for that. It's fine.
Let's get into timing a little bit. So a price is agreed upon. How long do they have to send you payments, and how long do you have to give them what you promised?
The way it works is that we will specify usually in the quote itself or in the communications channel where we give them quotes how we would like settlement. By default, it's 24 hours. So if we don't say anything, if you get it to us within 24 hours, it's fine. The reason that a lot of times we don't go with the default is because certain coins and assets have a lot more risk than others, right? If you don't settle Bitcoin with me, the exposure that I have, and I have a balance sheet on Bitcoin, it's not that bad, right? But if you sell me some rank like 100 coin, right, I want that immediately, This is very risky for me, A lot of it is ad hoc negotiated, but if there is no negotiation, then 24 hours is fine. And then once we receive the funds, technically we have 24 hours to settle back, but in practice, we settle immediately. And what I mean by immediately is as fast as the physical frictions in the world will allow. So if it's Bitcoin, we'll send it out immediately. You'll get it in the next 10 minutes, 20 minutes. There'll be a confirmation. It'll be fast. If it's a wire, then for domestic wires, if it's before the wire cutoff, which is 2 p.m. Pacific time, you'll get it the same day. If it's after the wire cutoff time, you'll get it the next day. If it's an international wire, but still in USD, wire cutoff time is 1 p.m. Pacific. If it's before the wire cutoff, it's 1 day. If it's after the wire cutoff, it's 2 days. So that's pretty much what the settlement speeds look like. And, obviously there's, smaller nuances like, certain chains are just a lot faster than others. But for the most part, crypto, we do it instantaneously.
The process is always, though, that they pay you, then you pay them. Is that right?
Yeah, we always take payment first. We're not comfortable shouldering counterparty risk for, all of our counterparties. It would be too difficult. I would say that the larger the institution they are, the more we would be comfortable maybe finding some kind of other arrangement. But even then, I would say the best way to go about it is first just to do a small trade and build up sort of a history of doing business. So why don't we start with something like 50 grand, right? And then work our way up to a couple mil.
Great. I think we covered everything that I can think of here. Is there anything else that A, you think we should discuss in this second chapter, or B, that maybe is notable for how this works with crypto OTC desks versus maybe more traditional OTC desks, when it comes to this end-to-end process for getting a quote and then executing the trade and finishing things up?
I think for the most part, that covers about everything. That was pretty much the in-depth full process. I mean, I guess there's more to do on our side. Like this is from the counterparty's perspective, but obviously for us, there's like a whole suite of stuff that we have to do, right? I mean, There's like, we have to do the accounting, the reconciliation. We have to do the hedging, all of that stuff, right? And daily P&L, we have NAV reports. We have a benchmark, internal benchmark fund, investor letters, like all sorts of random stuff too. Yeah, but not too relevant to the counterparty.
It seems like the ideal hire for you is not an adrenaline junkie, a deal junkie, but a very analytical, process-oriented, rational, almost OCD individual when it comes to execution. Is that correct?
Definitely the case, but I would also say that, we like to hire people who are not ultra specialized, I would say, because there's a lot to be done, right? And right now, the trading team, they handle a lot of things. They handle accounting, they handle trading, they handle a little bit on the sales side. In many ways, they handle the trading operations end to end, and each single one of them can do all of it end to end, right? So there's redundancy built into it too. I think it's good because eventually we will go towards specialization. And, as we become a bigger company, we're going to hire a specialist just to do one particular thing, but do extremely well. And I think, in some ways, having some kind of sort of founding group that does know every piece of the business, maybe not super well as much as a specialist, but that knows how it all fits together. I think it's going to be extremely important to how they coordinate between the specialists, and also in some ways for there not to be any resentment, right? I mean, we always hear about these sort of like middle managers, and then, you're working for them sucks, and, you're working for an idiot or something like that. And I think, for, the head chef to have worked as a line cook at some point, I think that does breed loyalty, right? Because nobody likes to do accounting, right? Accounting and reconciliation is the most painful thing. But, I've done it, and then my trading team has done it, and the people that we bring in, they'll understand that we've all gone through it. I think that helps a lot. I think that builds a more positive culture that if you're not willing to get your hands dirty, then why should someone else, right? I think that sort of is a good way to, have the culture.
Let's transition to chapter 3, put on our historian hats, and talk a little bit about the history of OTC desks. Let's discuss where this has come from, the origins of this business model, etc.
I would say that I'm much more familiar about crypto OTC and its history than I am about, OTC desks in general in the broader markets. I was probably still much too young at the time, well before my time. I'm happy to talk about in crypto sort of how it started. I think it all started probably with Genesis trading, right? So it's one of DCG's Digital Currency Group's arms. I think they ran the first, if I remember correctly, they ran the first OTC desk, at least the first major one. And one of their traders was a guy named Bobby Cho. Bobby, at some point, decided to leave Genesis and go to ItBit. It was around this time, and to build out their OTC desk. It was around this time that I was at Buttercoin, and Josh Lim, who was the former head of trading and treasury at Circle, was sort of starting up Circle's OTC desk. So, after Genesis, there was pretty much Buttercoin, ItBit, and Circle as the early players there. And then at some point, I know that they brought in Dan, and he has a really long, I think, Polish last name. I'm going to butcher it, so it starts with an M. They brought him in at Circle. So Josh and Dan were basically working together running the desk. Bobby was running the desk himself at ItBit. I was doing Buttercoin. And then at some point, there was sort of a changing of the guard. I know Bobby eventually left ItBit and went to DRW to start an offshoot called Cumberland Mining, which is a big OTC desk now. At the time, it was sort of a startup. And then also at some point, Buttercoin, basically fell through and closed down as a company. And I went over to Kraken. And then I started up the OTC desk over there. And then after I forget exactly how long, but I think this is already we're already at maybe 2016 at this point. And then at some point in 2017, Josh, he leaves Circle. Dan becomes head of trading over there. And then he goes to UBS to go back into traditional markets to trade. I think it was either like equities or like exotic options or something like that. I forget what it was. I always told him, and when he left, because we all know each other from back in the day. I mean, we were, in those days, I would say, just as a side comment, the sizes of the trades were much smaller than they are today. Like back in the day, I was so happy to just trade, $20,000, $20,000. Wow, that's just a nice block, we made $50, we made $100. What a, great, spent half an hour, made $50. Not bad. Very different from, how it is today where the largest clip that I've ever heard of across was in a single trade, 75 mil, right? So, just the sizes and the magnitudes of the trades have gone a lot bigger. And, obviously it's gotten very lucrative, right? Nobody's just picking up, $50 anymore. I think there's some folks out there that won't even take a call for less than $1,000, so it's very different from what it used to be. But, I told Josh when he was leaving, I always joked with him. I said, nobody ever leaves crypto, you're just going to be back at some point, and, sure enough, he's back, so fast forward like a year, right? To a year and a half or something. And now he's a trader now at the Galaxy's OTC desk, on Galaxy's OTC desk. So you basically see the same guys, over and over. A lot of new faces now, but some of the old guys still around, still doing OTC. And, Genesis is still operating. Cumberland is still operating. Itbit, maybe, I don't even know. Maybe they kind of closed down. Buttercoin closed down. Kraken's still operating. I passed on the desk to another head of trading. And then there was like another change of guard over there. And then, Circle's still trading, doing well. And then Galaxy is setting up their new OTC desk. So that's sort of how it looks, I would say, on the Western hemisphere. There's a lot of, smaller OTC desks. There are plenty all over the place. I mean, so much of OTC, and I think this is something that's a little bit kind of a good thing about OTC, is that it's as much about sales as it is about trading, right? Because you need to find the counterparties. And because of that, you can have these smaller competitors come up, right, and start to build their own book of business. That's really a nice thing because it also means with more competition, at least for the counterparty, it's a nice thing. It means that prices are going to get better and better and spreads are going to get tighter and tighter. So unlike in some ways natural monopolies or natural oligopolies like exchanges, right, where it's just very hard to start a new exchange, right? And it's just very hard to take market share from incumbents because liquidity effects are so strong on liquidity and trading and flow. But on sales, a startup can, they can do sales and they can build up their own book of business. They just have to hustle really hard. There's still network effects, just less. So that's just a side comment I wanted to make. Outside of that, there's in Asia, there's a whole bunch of OTC desks. From what I've seen, their spreads are anywhere, and in Europe too, anywhere from 2 to 3x as wide as in the US. So I don't know if it's the case because there's not enough competition or it's for some other reason. Like I have some theories that maybe they have some captive flow because a lot of these guys doing OTC desks also do ICO investment and also do market making. So they provide sort of full on financial services for the companies or the projects that they're incubating. So maybe they're then able to charge much more than normal. Or maybe it's just because there's been such a huge crackdown on exchanges in China that, everybody just needs to trade OTC and are willing to pay a bigger premium to do so because liquidity otherwise is very thin. So, it could be any of those reasons, but for whatever reason, they're very expensive over there.
Let's discuss a little bit motivations for starting an OTC desk. OTC seems to me like less of a sort of a core business model and more just a way of executing trades. And I often see OTC desks, paired with other business models that it serves some function to have an OTC desk. So I've seen mining companies have an OTC desk because it sort of behooves them to do so. You guys are a hedge fund with an OTC desk, with a strong quantitative bent. It seems very common to have an OTC desk attached to another business model. Does that seem to be true to you? And what are sort of the common types of business models that are paired with at least crypto OTC desks?
Yeah, I would agree to some extent and disagree to some extent. So I think there are a lot of miners with OTC desks. They have a very specific problem where they do need to trade these huge blocks. So having someone internal is a good way of sort of keeping the desks honest externally, right? So they still need to offload, but then you have a guy that's just really thinking about the prices. And the sizes are so huge, the notional sums of money are so huge that it's worth paying a guy just to do that, right? For hedge funds, yeah, certainly it helps to have OTC. Even if you're a long fund and, you want to rebalance your portfolio or you want to gain or lose more exposure in one asset or another, then doing OTC is a good way to do it. And it's a good way to supplement alpha if you're on the quoting side, right? So yeah, on those points, I definitely agree. And I think, there's a lot of other cases where there's OTC desks, with exchanges, for example. There's OTC desks with asset managers. So all of that I think makes sense. But I also think that there are some folks that are just dedicated to doing OTC. For example, like, with Bobby at Cumberland, it's what they specialize in. And I think that by itself, if you can have enough of a market share, if you have enough flow, it is a good business in and of itself. And what I mean by that is it's a business in the sense that you've built up a network of relationships that go to you for execution rather than anywhere else. And they don't want to build out their own execution. They're busy doing other things or planning out their strategies, maybe their macro strategies. They don't want to worry about the micro details of execution. So, they'll continue to work with you, right? And you've built out that sort of relationship. I think certainly people do appreciate the white glove service. Arguably, someone could build out some software that is basically an RFQ system or a request for quote system, right? So you log in and there's just a bot on the other side and you say, hey, I want to buy, 100 Bitcoin, just like with OTC, right? And then the bot spits you back a price and you can click confirm or not, right? So some people do use that. And I don't mind it at all. I think it's quite good, but I think some people don't care for it, right? Some people want to be able to ask questions. Some people want to just hear another person on the other line. Sometimes you just want to talk shop and say, hey, what do you think? So what's going on with the market? What do you think is up with Tether? Why is it trading at 96 cents on the dollar? Is Noble Bank going bust? Like what's going on? So I think, it's just part of the skill of, I think, OTC is just banter. You just got to be really good at bantering. That's I was just half joking, I guess. But I think there's some quality, there's some human quality to it that people really do appreciate.
And the banter aspect makes sense. It seems like there's a lot of people out there who would like to know more about what's happening in the crypto markets, and who better to ask questions about that, of than someone whose livelihood is 100% dependent upon knowing what's happening. To the extent that they can get a little, free advice or to educate themselves, it's probably, it's worth some basis points in there potentially on a trade.
Yeah. And I'd also add that, a lot of rich people are very old, right? And they don't want to have to go to a website and log in, and maybe they don't use a password manager and they forget their password and how does it work again, and got to click through this and that. They just want to call up somebody and say, hey, I just want to buy 1,000 Bitcoin. And they're like, okay, gotcha. I'll get it done for you, And it's really that, it's that kind of quality of service, you just tell someone and then it's done, you don't have to worry about it. And I find that when you save rich people time, they're willing to pay for it because time is extremely valuable to them. So they just don't want to deal with the hassle. They don't want to be thinking about it or worrying about it. They just want to know that it was done properly.
So that concludes part 2 of this conversation with Kevin Zhou from Galois Capital. In part 2, which comes next week, we discuss the components or attributes of OTC desks, the range of OTC desks that can exist, and the different types of institutions that create them and their various motivations for creating them, control and regulation, and what the future holds for OTC crypto trading and the business model. See you next week.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.